President Biden, who grew up in a family where the price of gas was a kitchen table issue, has elevated easing price pressures as his top economic priority. We economists think of this in terms of inflation, inflationary expectations, interest rate changes, a vast array of complicated concepts and measurements. But the fact is that it comes down to affordability and the need among American households for a bit of breathing room in making ends meet. Therefore, we're very happy to report that the current drop in the price of gas, down 50 cents per gallon over the past 34 days, is one of the fastest decline in retail gas prices in a decade. At current prices, the average American driver will spend about $25 per month less on gasoline than they would have if prices had stayed at their June peak. Economy-wide, that means American drivers are saving around $190 million each day from lower gas prices. And since gasoline prices affect the prices of other goods and services through transportation costs, food is a good example, both households that drive and households that don't yield some benefit from lower gasoline prices. Now, the decline in retail gas price is not a daily blip. The chart behind me shows that gasoline prices have declined every single day for the past 34 days. Just yesterday, we witnessed the largest single-day decline in national gas prices since 2008. As we all know, in contrast to the, quote, law of one price they teach in Econ 101, gas prices vary from place to place. But according to an industry analyst, around 20,000 gas stations across over 30 states are now charging less than $4 per gallon. Now, we know this is a volatile market. That's one reason we're highlighting a trend here and not a blip. But if you look at the about $20 decline in the price of oil since early June, as well as the drop in, that's on the next chart, as well as the drop in the wholesale gas price, we think it's reasonable to expect more gas stations to lower their prices in response to lower input costs, and thus, barring unforeseen market disruptions, to see average prices fall below $4 per gallon in more places in coming weeks. While there's a lot that goes into setting the global oil and gas price, the historic actions taken by President Biden to address the impact of Putin's invasion of Ukraine have helped and continue to help to increase the global supply of oil and therefore are in the mix of factors driving down the price. Because the president's announcement on releasing 180 million barrels from our strategic petroleum reserve and another 60 million from our global partners was back in March, I suspect there are people who forget about this critically important intervention in energy markets. But this action is very much in play in today's market, currently releasing a record 1 million barrels of oil per day on average and 84 million barrels so far. These releases have had an outsized effect at a time when the market is especially tight. In fact, as one leading oil market analyst put it, quote, "The U.S. has become the world's oil barrel of last resort, single-handedly keeping prices in the energy market from exploding even higher by selling a large chunk of its strategic petroleum reserve," end quote. Two further points before we take your questions. As gas prices are coming down, our labor market, which is where working-age families get most of their income, remains historically very strong. Job gains continue to come in at historically high levels. Private sector employment has surpassed its prior peak, and the jobless rate has been at 3.6%, just about its pre-pandemic level, for 4 months in a row. As someone who has carefully tracked labor market recoveries for decades, I assure you that this one is already in the record books for the speed of its recovery, and there's no question that the American Rescue Plan, with its shots in arms and checks in pockets, helped to achieve that goal. Finally, while the lower gas price creates some much-needed breathing room, American households need a lot more. Congress has enormous opportunities to help by continuing progress on both prescription drug costs, the cost of health coverage, and long-term growth with CHIPS Act. I cannot overemphasize the importance at this moment in our economic expansion for taking action on these crucial supports for family budgets and for long-term growth and economic security. Thank you, and Karine will call on folks.
Thanks, Karine. Jared, is the administration preparing for a recession? And how do you react to companies like Apple and banks saying today that they intend to slow hiring because the economy is slowing?
So let me tell you a little bit about the way the National Bureau of Economic Research Business Cycle Dating Committee, that's the group that decides recessions, makes their call. They weight a couple of variables pretty heavily, and one of them is payroll employment. Now, based on payroll employment, which, by the way, of course, relates to the unemployment rate, 3.6%, an historically very low unemployment rate for the past 4 months. Those kinds of statistics are anything but recessionary. Now, that's very much a look at the job market today. Slightly more forward-looking is if you look at consumers, and by the way, the bank reports I thought had this in their earnings reports. They talked about the strength of the American consumer. If you look at retail sales from just last week, you'll see American consumers still helping to fuel an economy that's delivering really remarkable job gains. So I think, and by the way, that in itself relates to something I kind of referenced in my opening comments, the fact that not only do people have the benefit of an historically strong job market behind them, a real tailwind in this economy, many also still have excess savings. This is one of the things that's helping to fuel consumer spending, which again is 70% of our economy. So I think if you look at the strength of the current economy, if you look at the strength of the labor market, if you look at the strength of consumer spending, you would conclude that where we are right now remains solidly within expansion.
Okay, and just one follow-up to that. I'm sure we all remember a year ago, other colleagues of yours stood here and said inflation was transitory and was not going to last and was certainly not going to go up to where we are now. Do you think it's possible in a couple of months you might regret standing here and saying we're not about to be in a recession?
Well, I want to be very clear what I'm saying. What I'm saying is that based on consumer spending, based on payroll employment, based on where the unemployment rate is, I think we can confidently say that these numbers that we're posting are very much inconsistent with a recessionary call given where we are right now. I think that is the most accurate way to assess the answer to that question.